Hey guys, it's Justin Goodbread with Financially Simple. So here we are in the second week, and I know there's going to be a couple of people jump on. Some various folks have already reached out during the week and said, Justin, I have some questions for you. So as you may be aware, on Thursdays, we're answering client questions or questions I hear from clients during the week, the ones that I think are the coolest or one that challenges me to try to figure out what we're dealing with. So on Thursdays around about 4:30, depending on schedules. And we're trying our best to do it on 4:30, but folks, I have a business to run and clients to meet. And so this last week we had a meeting that started at 4 o'clock. So we started the Ask Justin questions at about 3 o'clock. We had a couple of people jump on and listen to the episode about Shark Tank. If you didn't get a chance to hear it, take a listen to it. It was dealing with patents and how Shark Tank and why the people on Shark Tank are thinking about those particular things. Now, today, besides my business partner behind me playing phones really loud behind me, today we're going to deal with answering questions from you guys. And I got to start off with one question I've already received today, and that's this. Justin, a while back on one of your episodes, one of your videos, you said you want business owners, you expect business owners to invest extremely conservative. And I was like, I don't think I said that. So I had to go back and listen to it. And you know what I did? I messed up. What I meant to say is I want business owners to invest as conservative as possible to reach their goals. That should have been what I said. So I need to clarify that. But even when I was talking to the individual who pointed out that I said extremely conservative, not meaning to say that, he said, Justin, will explain that. Why in the world would you want business owners to invest as conservative as possible? And here's why. First of all, as conservative as possible deals with a number of different things, but more importantly, it deals with a big macro picture. You see, as a business owner, oftentimes our business is the single largest asset that we have. It is. It's often, it carries a lot of risk. It's called company-specific risk. Our business carries a lot of risk with it. And for many business owners, they don't want to take the time to understand the financial markets, and they hire advisors like myself to manage those things for you. Well, the last thing, I'm talking as a business owner, this is my preference. The last thing I need as a business owner is to have my business, which is very aggressive, dip, and at the same time have my long-term portfolio dip at the same time. Now, when I say as conservative as possible, one of the things I want to be careful on is I'm not talking about in the sense of like most people. See, a lot of business owners, we have a tendency to be risk takers. And I see business owners who want to go out and they invest in some crazy stuff, like things that the average Joe wouldn't invest in because it gets them excited. It's something new. It's something exciting. So whenever I say I want you to invest as a business owner as conservative as possible, what I mean by that is to not fall whim or not fall prey to every new idea of investing out there. It's not the idea. Instead, get a really, really good low-cost portfolio invested in, for most of us my age, most people invested in good long-term equity positions. So I think a good portfolio for business owners should include small cap and mid cap and large cap growth and value sectors. I think it should include things like emerging markets and international positions. I think a good portfolio for business owners would include things like commodities and REITs or real estate type investments or master limited partnerships. There's nothing crazy or erotic or super risky, relatively speaking, about those asset classes. Those are very generic, simple, mom and pops every day use this type of business or these type of investments. Compare that to a lot of times that I hear business owners, they'll come in and say, hey, Justin, I found this really cool new thing that's brand new. And whenever I hear that, my radars go off. I have a tendency to agree with a lot of the talking heads in this one point. You know, your Jack Bogles, they call them Bogle heads, Bogel, I think it is, Bogle heads. I'm not going to try to spell because the people on here will start laughing at me if I do. But Bogle heads, I mean, just buy good index funds, good broad market index funds. Dave Ramsey goes on the air and he says, hey, buy a good growth stock mutual fund. I agree with that. I agree that that should be part of it, not holistically, but that should be part of it. Susie Orman, I'm actually going to agree with her on this. She says that most people should have a very good low-cost diversified portfolio. I agree with that. What I meant by saying to have a conservative portfolio is to stay away from the nonsense that so many business owners that I see business owners fall prey to. So that's my challenge. That was the question I received for one particular client this week when he went back and watched a video. He said, Justin, I'm really not sure on why you said that business owners should invest extremely conservative. I said, man, I'm sorry about that. I don't think I said extremely conservative. And actually I did. He was right. So I was like, oh man, let me correct that. So it was a good point that he made. You're talking all day long and I'm human, folks. I mess up. So that being said, today, the challenge for you is to stump Justin. Stump Justin. Now, here's the challenge. First of all, it shouldn't be that hard to stump me. Shouldn't be. I've had a couple of peers already come in from behind the scenes, and these are CFPs and industry professionals, and they've thrown some challenging questions at me already. One of them said something. I went, let me think about that one. No, I got you. And he couldn't get me. He tried. But no, we were talking behind the scenes, and the guys here and gals here at the office, they said, you know what, Justin, we get so many questions through social media. By the way, you can connect with me on Twitter, on Facebook here, personal Facebook. We're working on opening that up as well. LinkedIn, Instagram, if you want to see pictures of chickens. I took a picture of Miss Emily walking out of the chicken coop with a bunch of chickens. But connect with me. That's a good way to ask a question. I get questions all the time that way. Another way that you can connect with me is if you just want to email me a question, you can email me at justin@financiallysimple.com. The team here gets the email and they filter out we get a lot of spam, as you can imagine. We got a lot of stuff going out. So we get folks all the time saying, you know, Justin, or the folks all the time trying to sell us stuff or get me to sell our client stuff. So put it inside there, ask Justin inside the subject line if you have a particular question. And if it's a good question, we'll come on here next Friday and we'll answer that question live on the air. That's another way you can do it. Or for those of you who are tuned in right now, if you want to reach into the write a comment and just dump a question inside there for me on write a comment, and that can see it, and I see questions already starting to come in. That'll give me a chance to kind of look at it. I'll try to answer a question and then go to the next question and so forth, so on. So what type of questions could you expect me to answer in here? Well, as a certified financial planner, I deal with things in the neighborhood of cash flow management. I deal with things as it relates to what's called risk management. Risk management deals with insurances and legal documents like estate planning documents, wills and trust, different things of that nature. As a CFP, we had to actually pass some pretty hard exams on that. All types of investments. You know, a lot of financial advisors out there, they're really, really, really good, very well niched into the micro area of the market about talking about stocks and bonds. But perhaps, there's one of my dearest friends in the world right now just jumped on. Hey, Mike, how are you, buddy? But you might, if you have questions about stocks and bonds, if you have a question about mutual funds, if you have a question about real estate and what makes a good real estate investment property, if you have a question about, like one I fielded today is, Justin, should I pay my house off or not? There's times when you may want to do that. There's times you may not. Hey, Ben, how are you, friend? So if you have a question as it relates to anything from cash flow, taxes, investments, real estate, insurances, legal documents. I'm not a lawyer, but man, we have to deal with legal documents from estate planning purposes. One of the questions that I had just the other day in a client meeting is, Justin, there's this thing called the 4% rule. What does that mean? So I explained that to a client. So you can ask any questions as it relates from a CFP perspective, as it relates to personal finance. I'll see if you can stump me. Maybe you can. I study a lot, and the guys here in the office are like, Justin, we're going to have a stump question challenge for anybody out there who wants to ask you a question. If they can stump you, if you can't answer it live on the air, we're going to enter their name. I'm going to make a note of who it is, and the team they'll be watching this in the repeat. And we'll enter you into a drawing and we'll have a prize for you. And then I'm going to go study and find out what exactly you stumped me on. So if you have any personal finance questions, but also as a business owner, one of the things you may want to look at is how do you grow your business? See, as a certified exit planning advisor and as a certified value growth advisor, a lot of my training is also deals with business owners. How do we grow the business? How do we not grow the business? How can we grow the net worth of the business, the value of the business so we can sell the business? How do we sell the business with minimizing taxes? Man, if you can ask any questions about business, that's where I've been really honing my skills in the last 3 years, doing a lot of training. In fact, this year I was up in Boston in Massachusetts and dealing with some really smart people up there, MIT area, and learning all about business valuation, actually how to perform a business valuation. So ask anything you want, see if you can stump me. And with that, let's see here. This is probably not a stump Justin, but question. Is there one question that I could ask my portfolio manager that would tell me if he knows his stuff or not? Ooh, that's a really good question. One question. Let me think through this a little bit. I could think of a lot of questions to ask a portfolio person, but that one question. So let me give you a couple, and I think it's going to vary based on the different type of, quote, portfolio manager you're going to deal with. So one of the first questions that I would tell anybody to ask their financial person is this. Number one, are you a fiduciary? So we talked about that a little bit last week. Now, a fiduciary is someone who has to do what's in your best interest. And you're like, Justin, man, I think it's all financial people. And that's sadly not the case. A lot of the, quote, financial people out there are not fiduciaries. They work underneath the suitability rule. And I used an example last week talking about coffee cups because someone asked me about the fiduciary rule. And so if you want to go back and check out last week's video, you can find it here on Facebook. You can also check out the YouTube channel. Hey, by the way, while you're there, subscribe. So one question I would ask is, are you a fiduciary? So that's the first question I would ask. The second question you may want to ask is, how do you get paid? And here's a good question. What is the total portfolio fee? This is where a lot of folks get tripped up on. See, they go online, they Google, and they say, well, the portfolio fee average nationally is 1%. Well, yes and no. So if you have $1 million, it's actually right at about 1%. It's the national average for the advisor fee. If you have less than $1 million that an advisor is managing, I think it gets in that 1.2, 1.3 range. I think I have a blog post on this on financiallysimple.com where I dealt specifically with fees. I think it's 1.25. I may be slightly off on that point something. So if you get under $1 million, the advisor fee is going to get a little higher. And the reason for that is the same amount of work no matter the portfolio, okay? Now, if you get over $1 million and you start creeping up in the $3, $4, $5 million to manage money, all of a sudden your portfolio fee could be somewhere in the neighborhood of about 0.8, 0.75. Now, that's the advisor fee. So going back to Flooding Love's question here is, what's the one question? You know, I talked about the fiduciary question. Are you a fiduciary? You may also ask, what's the total fee on my portfolio? If they give you a rote, well, the advisor fee is X, and I see this a lot with the wirehouses, the big names that you and I would recognize. They don't talk about the three things which drag down a portfolio more than anything. So let's talk about those, and this will help you analyze this question when I'm asking. The question is, what I'm answering here is, name the one question that I could ask my portfolio manager to find out if he knows the stuff or not. The question you may ask is, what's my total fee on the portfolio? If they tell you first the advisor fee and leave it at that, they're not being quite forthright. They might not be digging down deep enough. So in a portfolio, you have the advisor fee. You also have the investment fee, okay? The investment fee is what the exchange traded fund, the trade fees are, like if you're buying and selling stocks, the mutual fund fee, all these different fees come into play. So on average, you can build a portfolio that's 1.5, 1.4, 1.3 total fees. But where it gets it is this. Most people, and this is Vanguard did a real good study on this. Most people think that the advisor fee is what drags down the portfolio the most. In fact, you hear a lot of the bogle heads out there talking about, well, the advisor costs too much. Okay, first of all, that's number 3 on the list of what drags a portfolio down. First on the list is asset allocation. How much of your money you have allocated toward small cap growth versus large cap growth? How much money you have allocated toward international positions versus domestic or US positions? Are you buying positions in Japan or are you buying positions in the United States? That's called asset allocation. How much what's called fixed income or bonds, things of that nature, preferred stocks, kind of a hybrid fixed income. How much bonds versus stocks do you have? So the number one thing for the return of your investment in a portfolio is asset allocation. The second thing is not the advisor fees or not the fees. That's where misconception is. It's actually the taxes on the portfolio. And you say, Justin, I don't have any taxes on my portfolio. I have it in an IRA. Well, not exactly. See, if you have a mutual fund or if you have an ETF, there's what's called turnover. Turnover is when the manager, the professional manager, is actually holding, or they're actually buying and selling the position. So let's say we have a position that is large cap growth and they're buying Apple and selling Apple. By the way, disclaimer, I have to do this for compliance reasons. In no way am I giving you specific financial advice. This is just educational purposes only. I'm going to tell you to talk to your specific certified financial planner. Okay, so back on track. When the money manager in a mutual fund or an ETF is turning over, they're buying a stock and selling a stock, buying a bond, selling a bond. What is transpiring there is a tax effect at the fund level, at the mutual fund level. So if you have investments that's what's called non-qualified, or they're not in IRAs or 401ks or 403bs and things of that nature, just in a plain Jane husband and wife account. One of the dangers oftentimes is young rookie advisors, they'll go in and they'll buy mutual funds like in the last quarter of the year. Like right now, they're going in and buying mutual funds. What happens is, especially real bad in December, you go into December, you buy them in a non-qualified account, all of a sudden you're going to get 1099s or you're going to get tax forms in early April that says you're having to pay for all the gains of that particular position for the calendar year previous. See, so go back to Floating Love's question here. What's the one question that I could ask my portfolio manager that would tell me if he knows his stuff? I would say, are you a fiduciary? If they're not, run. Number 2, what's the total fee? Total fee. That's going to let you know as they start explaining this, do they really know what's affecting that portfolio, what's involved with it? Okay. So ask them what the total fee is. Now, if you really want to trip them up and you just giggle a little bit just for fun, I don't expect any average financial advisor to know this. I don't. But you may ask them this thing called what's a R-squared ratio, or what's a Sharpe ratio, or what's the alpha, like an alpha beta, what's the alpha of my portfolio? If you ask them those questions, they could jibber jabber on for a good hour or so, but it's fun to listen to them kind of stammer. I like to do that myself when I'm in the midst of other financial advisors to see if they know their stuff or not. So Flooding Love, you're still on here. Just let me know. I think that answers your question. Another thing you may ask, I'm just thinking out loud here as we go through this. Many times advisors, you'll go to the financial advisor and you'll say, hey, Mr. Financial Advisor, I have this portfolio here. Let's call it an IRA. I rolled it over from an old 401k years ago. You know, I always say, I got that, Flooding. If you leave your company, take your money with you. That's what I always say. So you move some money into a 401k, and now you're from a 401k to an IRA, and you go into the financial advisor's office. They're going to ask you questions like, what other assets do you have? Now, they do that for a couple of reasons. They do that to check and see if what your risk tolerance is. They do it because compliance and the regulations that we follow, we have to document what the total assets are. They do it, ultimately, they should be doing it to make sure they're not doing what's called a fund overlapper or trying to ultra diversify your portfolio. One of the mistakes many people make when they come to see us at the office or they go see a financial advisor is they'll say, hey, Mr. Financial Advisor, I have this one portfolio that I want you to look at, but not all these others, okay? In our office, whenever someone comes to see us, we start off with a written financial plan right off the bat. You got to do a financial plan. We got to put all the numbers out there. We got to know where we're going and why we're going to get there and how it works. Case in point, just this week in the office, we're wrapping up a financial planning process. By the way, it's like 5 meetings before we ever touch the portfolio. So we're like in our 5th meeting. I'm now starting to show this client what exactly his future looks like. And inside there, I put an overlay of all the different investment accounts together. So he has 401ks, they have 403bs, they have retirement accounts, they have CDs at the bank, they have cash accounts, they have a lot of different monies all over the place. But whenever I combine them all together, what ended up happening is the client had a ton of money in large cap value positions. They didn't have a lot of money over in large cap growth positions. Now, for those of us who've been watching the market this year, large cap growth is what's carrying the market. Small cap growth, the growth assets are carrying the market this year. Now, is that always the case? No, it moves up and down. But it's interesting that they couldn't see the overall portfolio because they were looking at one little account here and one little account here. When we took it and put it all together, we were able to show them that their overall portfolio is lagging big time because it's not properly diversified. So hope that helps you. Flooding Love, I saw you give me a thumbs up. Sorry to keep rambling on that, but it's there to help. All right, I had another question this week, and the question was, let me read that here. What would you say the top what would you say to someone who asks you about the CEPA? I don't know what that is, Justin. If you have any other questions, by the way, drop them in the feed here. We got quite a few folks on here today. So, hey, Brad, how are you, man? I hadn't talked to you in a while. So the question was, Justin, how would you describe a CEPA? And the way I would describe that is actually called a Certified Exit Planning Advisor, is what that's called. It's not a certified public accountant. So a CPA, you recognize that term, is a certified public accountant. They're ones who deal with accounting. They do audits, they do tax returns, they do financial forecasting, almost like a CFO does. And you have a lot of CPAs there. It's a very established credential. The CEPA, which is a Certified Exit Planning Advisor, what that is, and those of you who know I have that designation, is I have been formally trained many, many hours, lots of classroom time, a lot of CE, continuing education. In fact, I'm up I can't get the exact reward, but I may win the #1 exit planner of the year here in the country. I'm excited about that. Maybe it's most influential exit. I can't remember the exact details on it. We'll know about that in September. I'm actually speaking at the National Exit Planning Convention as a platform speaker, so I'm excited about that. But the CEPA is trained on how to take a business from today, where the business owner is today, and they say, hey, man, I want to retire in 5 years or 10 years and 15 years. They're trained on how to help that business owner get that business positioned so they can sell that company at some time in the future. And they're trained almost like hand-holding, holding that individual's hand and helping them walk through the transition on how to sell their business. I read a statistic. In fact, it's going to be in our new book that we have coming out called 10 and Out. There are currently just over 224,000 businesses in the next 10 years, which are going to try to sell. Now, that's just middle market. So middle market business, 224 middle market businesses in the United States in the next 10 years, which are going to try to sell. Hey, Alona, how are you? In the next 10 years, out of those 224 middle markets, so that's businesses that are worth $5 million to $100 million. In the next 10 years, out of those 225,000 middle market businesses, here's where it gets scary. Only 34,000 of those businesses will sell. Think about that. That's less than 12%, right? 12% of businesses in the next 10 years, only 12% are going to sell. Now, here's what it gets even scarier. For us business owners, out of those that do sell, so out of the 12% that actually do sell, 4% of the business owners are happy. 4%. That is crazy. So what a CEPA, answering one of the questions here, what a CEPA is it's an individual who's trained to work hand in hand with the business owners for many, 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 many years and help them get their business positioned over the period of time so that they can turn around and sell their business and not be a statistic. See, guys, business owners are the lifeblood. If you actually read the data between those businesses which are smaller, less than 100 million, all the way down to the size business that I have and a couple of the people I see on here, like Lisa, who runs a plumbing company. Hey, Lisa, here in town. We're the backbone of the country. We're the ones who are employing the majority of the employees. I mean, there's all sorts of data out there. What is so sad to me as a planner is business owners, they pour their lifeblood into their business, and then all of a sudden they reach this age of retirement. They haven't taken enough money out of their business like good employees do and save the money. They haven't done that. And now they get ready to sell their business and they have an asset they can't sell. So they're hoping that they can sell their business for retirement proceeds, but statistically, they're not going to be able to do it. It's such a minority. So the CEPA, to answer that question that came through, the Certified Exit Planning Advisor, sorry, it's Friday and my brain's fried. Everybody's trying to, this is why they want me to stump Justin on Friday. The CEPA is the individual that's been trained on how to hold somebody's hand and walk them through that particular process, the process on how to position their business for sale. So I hope that answers the question. If you have any questions, drop them in. I'm fixing to look at these other questions that are coming through very, very, very fast here. What do we got? Next question I got here is, would you rather I give you $1 a day for the rest of your life or $1,000 right now? Why? Wow. First of all, I'd have to have a calculator answer that question. $1 a day for the rest of my life. So that goes into what's called an annuity calculation. So we'd have to figure out what is the net present value of that annuity. So that'd be $365 a year. Let's assume 5%. I'd rather have $1 a day, I think, in my head. So what I'm doing in my head real fast, and again, if I had a calculator, and I'm not going to do this live time for you, I'm 39 years old. $1 a day is $365 a year. Let's say I live to be 85 years old. That means I have some almost 40 plus years that I could get $365 a day. I'd have to calculate out that, then you'd have to run the number, what's the total value, then bring what's called a net present value, bring it back to what today that value would be. I bet that number is greater than $1,000. I bet. So that's the first thing. Then I'd have to look at if I had $1,000 today and I invested it and I made 6, 7, 8, 9, 10% on that money, what would that do over life and how much income could I get out? So it'd be a mathematical equation side by side that we could calculate out. I can't run that math in my head super fast. My gut tells me it may be $1,000 today. I'm going to have to calculate that. I don't know if that's a stump Justin question. I could probably figure it out in like 3 minutes with a calculator right here, but probably $1,000 today is probably what I would take. Burn the hand is better than two in the bush. There's some risk on the annuity. Even if the annuity was valued at about $20,000, $30,000, you have to look at the crediting worthiness of that individual, that company who would pay you $1 a day for the rest of your life. You'd have to make sure that there's some risk there. You also have inflation involved. So I would probably go in and take $1,000 today. Again, I haven't ran the math on that question. It's a good question. It's a good question. I'd probably take $1,000 today. I'd have to double check my math on that one to make sure. Got another question here that came through on the private tweet. So let's answer this one. It says, what is a DBA and what are the advantages to it? So what is a DBA and what's the advantages to it? So this is coming through our Twitter channel. For those of you who don't know, we are on Facebook, LinkedIn, Twitter. We got a podcast, by the way. We're up at like episode number 85. I've already got like another 30 of them recorded or in the process of being recorded. And so you can check that out on Stitcher or Spotify, Financially Simple with Justin on Stitcher or Spotify. I talk for about 20 minutes, dive way deep into particular subjects. So let's go back to the question. The question is what is a DBA and what's the advantage to it? So D, dog, B, boy, A, apple. DBA stands for doing business as. So that's what a DBA is. It's, in other words, it's me, Justin, not a company, not an LLC, not an S corporation, nothing like that. I'm going to go out and sell chewed up butterscotches. My throat was hurting me in a meeting today, so I had chewed up butterscotch here. I'm going to go out and sell chewed up butterscotches, and I'm going to go door to door and knock on it and sell these butterscotches to folks. If I did that and I didn't have an LLC or S corporation or C corporation, then I would be considered doing business as. So I could say, my name is Justin Goodbread, and I'm doing business as the Chewed Up Butterscotch Company, or do Chewed Up Butterscotch Salesforce, whatever you want to call it. It wouldn't technically be a company. Now, the advantage to that is it's easy. Anybody can do that. In fact, there are more DBAs and solo businesses. Sole proprietors is what we often call those, or unincorporated businesses. There's more of those than there actually are major corporations. There's a ton of DBAs. So one of the advantages to a DBA is it's super simple. Now, one of the disadvantages is super simple. You don't have any asset protection. So if I'm out there driving in my personal vehicle doing business as the Chewed Up Butterscotch Company, and I hit the back of a car, or I run over a kid, or I kill a cow. Seen it all, folks. If I kill a cow and now the farmer sues me because that's his prize cow that I just ran over, yeah, I don't have any asset protection for that. So that's what a DBA is, doing business as. The advantages are super easy. The disadvantages is there's not a lot of asset protection on that. So I think I've answered all the questions coming through today. Guys, I'm going to jump off. It's Friday, 5 o'clock. Like I say every week, life is hard. It is. I've seen a lot of things this week. Life is good, though. Life is good. God is still on the throne. Life is good. Money can be complicated, but it doesn't have to be. Let's just continue to make our lives at least financially simple. Hey, y'all go out and make it a great day.